Question 1. Which of the following is a key characteristic of a whole life insurance policy? A. It provides coverage only for a limited term with no cash value. B. It has a level premium for the life of the policy and includes a cash value component. C. It allows the policyholder to adjust the death benefit and premiums on an annual basis. D. It does not provide any death benefit and only accumulates savings. Answer B. It has a level premium for the life of the policy and includes a cash value component. Explanation: whole life insurance is a type of permanent life insurance that provides a death benefit for the insured's lifetime as long as premiums are paid. The premiums are typically higher than those for term life, but they remain constant for the life of the policy. Additionally, the policy includes a cash value component that grows over time and can be borrowed against or withdrawn under certain conditions. Options A, C, and D describe features of other types of insurance or policies such as term life, adjustable life, or policies without cash value. Question 2. Scenario: Jane is a newly licensed insurance producer in Oregon. She is approached by a client, Mr. Smith, who is seeking advice on purchasing a life insurance policy. During their meeting, Mr. Smith mentions that he has recently been diagnosed with a serious medical condition and is concerned that it may affect his ability to obtain coverage. What should Jane do in this situation? Encourage Mr. Smith to apply for the policy as soon as possible without disclosing his medical condition to the insurer. B. Advise Mr. Smith to disclose the medical condition to the insurer as part of the underwriting process. C. Recommend that Mr. Smith seek coverage from a different insurance company that may not ask for health history. D. Ignore the medical condition as it will not affect the underwriting decision for life insurance. Answer B. Advise Mr. Smith to disclose the medical condition to the insurer as part of the underwriting process. Explanation: insurance producers have a duty to advise clients to be truthful and transparent during the underwriting process. This includes disclosing pre-existing medical conditions. Non-disclosure or misrepresentation could lead to the policy being voided or claims being denied in the future. Advising Mr. Smith to disclose his medical condition ensures compliance with ethical practices and legal requirements. Option is incorrect because failing to disclose information could result in future legal and financial issues. Option C suggests unethical behavior as no reputable insurer should bypass underwriting requirements. Option D is incorrect because the medical condition could impact underwriting decisions and ignoring it could lead to significant consequences. Question 3. What does the principle of insurable interest in an insurance contract refer to? A. The amount of money the insured pays in premiums over the life of the policy. B. The financial relationship that exists between the insured and the beneficiary in the policy. C. The potential for the insurer to make a profit from the policyholder's premiums. D. The requirement that the policyholder must have a financial stake in the insured property or individual. Answer D. The requirement that the policyholder must have a financial stake in the insured property or individual. Explanation: insurable interest is a fundamental principle of insurance that requires the policyholder to have a legitimate financial interest in the property or person being insured. For life insurance, this typically means that the policyholder must stand to suffer a financial loss or hardship if the insured person dies. For property insurance, the policyholder must have an interest in the property that would result in financial loss if the property is damaged or destroyed. This principle prevents individuals from taking out insurance policies on things or people in which they have no financial interest, thus preventing speculative insurance purchases. Question 4. Which of the following is true regarding the incontestability clause in life insurance policies? A. It allows the insurer to cancel the policy after the first year if the insured's health deteriorates. B. It prevents the insurer from denying a claim based on misrepresentation after the policy has been in force for 2 years. C. It allows the insurer to increase premiums after the first year without the policyholder's consent. D. It requires the policyholder to provide health information every year to continue coverage. Answer B. It prevents the insurer from denying a claim based on misrepresentation after the policy has been in force for 2 years. Explanation: the incontestability clause is a standard provision in life insurance policies that limits the insurer's ability to contest a claim after the policy has been in force for 2 years. If the insured dies after this period, the insurer cannot deny the death benefit based on material misrepresentations in the application except in cases of fraud. Option is incorrect because the clause doesn't allow policy cancellation for health reasons after the first year. Option C is incorrect because the clause doesn't allow for premium increases without the policyholder's consent. Option D is incorrect because the clause does not require the policyholder to submit health information annually once the policy is active. Question 5. Scenario: Tom is seeking health insurance coverage under a new policy. During the application process, he discloses that he has been treated for high blood pressure for several years, but is currently managing it with medication. The insurer agrees to issue the policy but adds a pre-existing condition exclusion for any treatments related to high blood pressure. What is the insurer's right regarding this exclusion, and how does it affect Tom's coverage here? The insurer is allowed to deny all claims related to Tom's blood pressure even if they occur after the policy begins. B. The insurer is allowed to exclude coverage for any blood pressure treatments for specified period, typically up to 2 years. C. The insurer is not allowed to exclude coverage for pre-existing conditions under any circumstances. D. The insurer can only deny claims if Tom's blood pressure condition worsens during the first year of coverage. Answer: B. The insurer is allowed to exclude coverage for any blood pressure treatments for a specified period, typically up to 2 years. Explanation: Many health insurance policies include provisions that allow for exclusions of pre-existing conditions, typically for a period of time, often up to 2 years. These exclusions apply to conditions that were present before the policy's effective date. This ensures the insurer is not liable for treatments related to conditions the insured had prior to purchasing the policy. Option is incorrect because the insurer cannot deny all claims, only those related to the pre-existing condition. Option C is incorrect because pre-existing condition exclusions are commonly applied in health insurance. Option D is incorrect because the exclusion does not depend on the worsening of the condition within the first year, but is blanket exclusion for treatments related to the condition during the exclusion period. Question 6. Which of the following best describes the standard fire policy in property insurance? A. It provides broad coverage for both fire and water damage. B. It is a basic policy that covers fire damage and limited additional perils. C. It covers all types of property damage, including theft and vandalism. D. It offers coverage for natural disasters, including earthquakes and floods. Answer: B. It is a basic policy that covers fire damage and limited additional perils. Explanation: The standard fire policy is a basic property insurance policy that provides coverage for damages caused by fire. It is typically very limited in scope and may cover a few additional perils such as lightning or windstorm, but it does not cover water damage, theft, or natural disasters like floods or earthquakes. Option is incorrect because the standard fire policy does not cover water damage. Option C is incorrect as it does not cover theft or vandalism unless an endorsement is added. Option D is incorrect because earthquakes and floods are generally not covered under a standard fire policy. Question 7. What is the primary purpose of underwriting in insurance? A. To ensure that the insurer's premiums remain competitive in the market. B. To determine whether the risk of insuring an individual or entity is acceptable. C. To decide the type of coverage that should be provided to the insured. D. To calculate the amount of coverage a policyholder should receive in the event of a claim. Answer: B. To determine whether the risk of insuring an individual or entity is acceptable. Explanation: Underwriting is the process by which an insurance company evaluates the risk of insuring an individual or entity. The underwriter assesses the applicant's health, financial status, and other relevant factors to determine whether to offer coverage and at what rate. It's not primarily about ensuring competitive premiums or determining the type of coverage, although those may be affected by underwriting decisions. Option is incorrect because pricing is not the sole purpose of underwriting. Option C is incorrect because underwriting evaluates risk, not necessarily the type of coverage. Option D is incorrect because the amount of coverage is generally determined by the policyholder's needs and the insurer's guidelines, not by underwriting alone. Question 8. What is the role of the National Association of Insurance Commissioners (NAIC) in regulating the insurance industry? The NAIC enforces all insurance laws and imposes penalties for violations. B. The NAIC provides a uniform set of standards for insurance regulation and practices across states. C. The NAIC directly issues insurance licenses to producers and companies. D. The NAIC regulates the pricing of insurance premiums at the federal level. Answer: B. The NAIC provides a uniform set of standards for insurance regulation and practices across states. Explanation: The National Association of Insurance Commissioners (NAIC) is a regulatory support organization that provides a forum for state insurance regulators to develop and promote uniformity in insurance laws and regulations across the country. It does not enforce laws directly or issue licenses, but helps states create common standards for regulating insurance. Option is incorrect because enforcement is done by state insurance departments, not the NAIC. Option C is incorrect as licensing is managed at the state level. Option D is incorrect because the NAIC does not regulate federal pricing for insurance premiums. Question 9. Which of the following statements is true regarding the waiver of premium rider in a life insurance policy? A. It allows the policyholder to stop paying premiums if the insured becomes disabled and is unable to work. B. It provides additional coverage for accidental death benefits. C. It reduces the policy's premium payments if the insured exceeds a certain age. D. It allows the insurer to raise the premiums if the insured becomes seriously ill. Answer A. It allows the policyholder to stop paying premiums if the insured becomes disabled and is unable to work. Explanation: the waiver of premium rider is a provision in life insurance policies that allows the policyholder to stop paying premiums if they become totally and permanently disabled. This rider ensures that the policy remains in force even if the insured can no longer afford to pay the premiums due to their disability. Option B is incorrect because accidental death benefits are separate from the waiver of premium rider. Option C is incorrect because the rider does not affect premiums based on age. Option D is incorrect because the rider does not allow for premium increases due to illness. It suspends premiums if the insured becomes disabled. Question 10. Scenario: Sarah is an insurance producer who recently met a new client, Mr. Parker, interested in purchasing life insurance. Mr. Parker disclosed that he had previously been denied coverage by another insurer due to his history of heart disease. What should Sarah do in this case? A. Sarah should advise Mr. Parker that he will likely be denied coverage by any other insurer due to his heart disease. B. Sarah should encourage Mr. Parker to apply with the same insurer that denied him coverage to see if his condition has improved. C. Sarah should explain to Mr. Parker that insurers cannot consider his medical history and will offer coverage regardless. D. Sarah should suggest that Mr. Parker disclose his medical condition and explore policies that may accept high-risk applicants. Answer: D. Sarah should suggest that Mr. Parker disclose his medical condition and explore policies that may accept high-risk applicants. Explanation: Sarah has a duty to help Mr. Parker understand the underwriting process and the importance of disclosing his medical history. Some insurers may offer coverage to individuals with pre-existing conditions, often with exclusions or higher premiums. It's important to explore options available to high-risk applicants. Option is incorrect because some insurers may still consider offering coverage even with pre-existing condition. Option B is incorrect because Mr. Parker should consider other insurers, not just the one that denied him. Option C is incorrect because insurers are legally allowed to consider medical history in the underwriting process. Question 11. Which of the following is an example of an excluded peril under a homeowner's insurance policy? A. Fire damage. B. Theft of personal property. C. Damage caused by a flood. D. Windstorm damage. Answer: C. Damage caused by a flood. Explanation: flood damage is typically excluded from standard homeowners insurance policies. Policyholders often need to purchase separate flood insurance policy to be covered for this risk. Fire, theft, and windstorm damage are generally covered by standard homeowners insurance policies, although certain limitations may apply. Question 12. What is the purpose of the coinsurance clause in a property insurance policy? A. To prevent the insurer from paying out the full value of the claim. B. To reduce the policyholder's premium payment. C. To ensure that the policyholder insures the property for at least specified percentage of its value. D. To increase the payout the policyholder receives for losses due to underinsurance. Answer: C. To ensure that the policyholder insures the property for at least a specified percentage of its value. Explanation: the coinsurance clause requires the policyholder to insure their property for a specified percentage, often 80%, 90%, or 100% of its value. If the insured fails to do so, they will only receive a partial payout for any loss, which is determined by a coinsurance penalty. Option A is incorrect because the clause is intended to encourage proper coverage, not prevent full payment. Option B is incorrect as the clause can lead to higher costs for the policyholder if underinsured. Option D is incorrect because underinsurance leads to reduced claims payouts, not higher. Question 13. What is a moral hazard in the context of insurance? A. The risk that an insured party will take excessive risks because they are protected from financial loss. B. A risk that results from changes in weather or environmental conditions. C. The likelihood of an accident occurring due to negligence. D. The act of intentionally damaging property to claim an insurance benefit. Answer A. The risk that an insured party will take excessive risks because they are protected from financial loss. Explanation. A moral hazard occurs when an individual or business engages in riskier behavior because they know they have insurance coverage to protect them from the financial consequences of their actions. This is contrasted with a physical hazard, which involves tangible risk factors such as weather conditions or the condition of property. Question 14. In what situation would an insurance company most likely use subrogation? A. When an insured's premium is overdue. B. When the insured causes damage to their own property. C. When the insurance company seeks reimbursement from a third party who is responsible for a loss. D. When the insurer denies a claim based on fraud. Answer C. When the insurance company seeks reimbursement from a third party who is responsible for a loss. Explanation. Subrogation is the process by which an insurance company seeks reimbursement from a third party that is legally responsible for a claim. For example, if an insured is in a car accident caused by another driver, the insurer may pay the claim and then seek to recover the costs from the responsible party's insurance. Option A is incorrect because subrogation does not relate to overdue premiums. Option B is incorrect because subrogation typically involves third parties, not the insured. Option D is incorrect because subrogation is unrelated to the denial of claims for fraud. Question 15. What type of life insurance policy offers both a death benefit and a cash value component? A. Term life insurance. B. Universal life insurance. C. Accidental death and dismemberment insurance. D. Disability income insurance. Answer B. Universal life insurance. Explanation. Universal life insurance is a permanent life insurance policy that provides both a death benefit and a cash value component, which grows over time. The cash value can be accessed by the policyholder and the premiums are flexible. Option is incorrect because term life insurance only provides a death benefit and does not accumulate cash value. Option C is incorrect because accidental death and dismemberment insurance provides a benefit only in the event of accidental death or injury. Option D is incorrect because disability income insurance provides income replacement in the event of a disability, not a death benefit or cash value. Question 16. Which of the following best describes an open perils policy in property insurance? A. It covers only the perils that are explicitly listed in the policy. B. It covers all perils except those specifically excluded in the policy. C. It is the same as a named perils policy but with a higher deductible. D. It only covers property damage caused by natural disasters. Answer B. It covers all perils except those specifically excluded in the policy. Explanation. An open perils policy, also known as an all-risk policy, covers damage caused by any peril unless it is specifically excluded in the policy terms. This is in contrast to a named perils policy, which only covers the perils explicitly listed in the policy. Option is incorrect because it describes a named perils policy. Option C is incorrect because an open perils policy is not defined by the deductible amount. Option D is incorrect because an open perils policy covers more than just natural disasters. Question 17. What is the best interest standard that applies to insurance producers and financial advisors? A. The requirement to offer the cheapest product available. B. The requirement to recommend a product that best meets the client's financial goals and needs. C. The obligation to disclose all sources of commission from insurance sales. D. The obligation to recommend only fixed-rate products to clients. Answer B. The requirement to recommend the product that best meets the client's financial goals and needs. Explanation. The best interest standard requires insurance producers and financial advisors to act in the best interest of their clients, ensuring that any recommendations or products sold meet the client's financial goals, needs, and objectives, rather than serving the advisors' or producers' financial interests. Option is incorrect because the cheapest product may not always meet the client's needs. Option C is important but not the definition of the best interest standard. Option D is incorrect because the best interest standard is not limited to fixed-rate products. Question 18. Under what circumstances may an insurance company cancel a policy midterm, A, if the policyholder moves to a different state, B, if the policyholder fails to pay premiums after a grace period, C, if the insurer decides to stop offering coverage in the market, D, if the insured cancels the policy voluntarily. Answer: B, if the policyholder fails to pay premiums after a grace period. Explanation: if a policyholder fails to pay premiums, the insurer may cancel the policy after the expiration of a grace period. The grace period is typically 30 days. Option is incorrect because moving to a different state does not necessarily result in cancellation. Option C is incorrect because insurers cannot arbitrarily cancel policies unless there are specific conditions that allow it. Option D is incorrect because the insured can voluntarily cancel the policy, but that is not the insurer's action. Question 19. Which of the following types of insurance would cover a company's losses resulting from business interruption caused by a covered peril? A. General liability insurance. B. Property insurance. C. Business interruption insurance. D. Workers' compensation insurance. Answer: C. Business interruption insurance. Explanation: business interruption insurance covers the loss of income that a business experiences due to a covered peril that disrupts its normal operations, such as fire, flood, or other disasters. Option is incorrect because general liability insurance covers claims related to bodily injury or property damage to third parties, not business interruptions. Option B is incorrect because property insurance covers physical damage to property, not the loss of income due to business interruption. Option D is incorrect because workers' compensation insurance covers employee injuries, not business interruptions. Question 20. Which of the following is the primary purpose of the Act of God clause in insurance contracts? A. To ensure that insurers are not liable for damages caused by natural disasters. B. To specify the amount of coverage for damages caused by natural events. C. To allow insurers to increase premiums after a natural disaster. D. To define the legal rights of the policyholder in case of a disaster. Answer A. To ensure that insurers are not liable for damages caused by natural disasters. Explanation: in Act of God, a clause in insurance policies limits or excludes coverage for damages caused by natural disasters such as earthquakes, floods, or hurricanes. The clause is meant to protect the insurer from financial loss due to events that are beyond human control. Option B is incorrect because it does not typically define the coverage amount. Option C is incorrect as the clause does not permit premium increases. Option D is incorrect because the clause does not specify legal rights but focuses on exclusions. Question 21. Which of the following is a key characteristic of a claims-made insurance policy? A. It provides coverage only for claims that occurred during the policy period. B. It covers claims for incidents that occurred before the policy was purchased. C. It covers only claims that are made during the policy period regardless of when the incident occurred. D. It provides coverage only for claims that are made and reported after the policy period ends. Answer: C. It covers only claims that are made during the policy period, regardless of when the incident occurred. Explanation: a claims-made policy covers claims that are made during the policy period, even if the incident that caused the claim occurred before the policy was purchased. Option is incorrect because claims-made policies focus on when the claim is made, not when the incident occurred. Option B is incorrect because this describes an occurrence policy, not a claims-made policy. Option D is incorrect because claims-made policies cover claims made during the policy period, not after it ends. Question 22. Under a standard homeowners insurance policy, which of the following would typically be covered? A. Earthquake damage. B. Flood damage. C. Theft of personal property. D. Damage from nuclear accidents. Answer: C. Theft of personal property. Explanation: standard homeowners insurance policies typically cover theft of personal property. Earthquake and flood damage are usually excluded, and nuclear accidents are not covered by most policies. Coverage for earthquake and flood damage may be purchased separately. Question 23. What is the primary function of a deductible in an insurance policy? A. To set the maximum amount the insurance company will pay out for a claim. B. To reduce the cost of premiums by transferring risk to the policyholder. C. To increase the payout amount to the insured in case of a claim. D. To establish the amount the insurer will pay for an event after the policyholder has paid their portion. Answer: B. To reduce the cost of premiums by transferring risk to the policyholder. Explanation: a deductible is the amount the policyholder must pay out of pocket before the insurer will pay for a claim. By choosing a higher deductible, the policyholder assumes more of the financial responsibility, which often leads to lower premiums. Option is incorrect because the deductible is a cost-sharing mechanism, not a payout limit. Option C is incorrect because the deductible reduces, not increases, the payout. Option D is correct in the sense that the insurer pays after the deductible, but the primary function is risk reduction for the policyholder. Question 24. Which of the following is an example of underinsurance in property insurance? A. Insuring the property for its market value. B. Insuring the property for less than its replacement cost. C. Using a high deductible to lower premiums. D. Purchasing additional coverage for natural disasters. Answer: B. Insuring the property for less than its replacement cost. Explanation: underinsurance occurs when a property is insured for less than its full replacement cost. This can lead to significant financial losses in the event of a claim. Option is incorrect because insuring property for its market value does not necessarily constitute underinsurance. Option C is incorrect because a high deductible is a strategy to reduce premiums, but it does not directly relate to underinsurance. Option D is incorrect because additional coverage for natural disasters increases coverage, not underinsuring. Question 25. Which of the following is typically excluded from coverage under a standard automobile insurance policy? A. Liability for bodily injury in an accident. B. Comprehensive coverage for non-collision damages. C. Damage to a rental car in a foreign country. D. Theft of the vehicle. Answer: C. Damage to a rental car in a foreign country. Explanation: damage to a rental car in a foreign country is often excluded from standard automobile insurance policies, though this can vary depending on the insurer and the specific policy. Option is incorrect because liability for bodily injury is generally covered under most policies. Option B is incorrect because comprehensive coverage typically includes damages not caused by collision, such as vandalism or weather events. Option D is incorrect because theft of the vehicle is usually covered under comprehensive coverage. Question 26. Which of the following best describes liability insurance? A. Insurance that covers damages to the insured's own property. B. Insurance that covers bodily injury or property damage to others for which the insured is legally responsible. C. Insurance that covers the insured's medical expenses after an accident. D. Insurance that covers the insured's income lost due to disability. Answer: B. Insurance that covers bodily injury or property damage to others for which the insured is legally responsible. Explanation: liability insurance covers the insured's legal responsibility for causing bodily injury or property damage to others. It does not cover damage to the insured's own property or medical expenses for the insured. Option is incorrect because it describes property damage insurance, not liability insurance. Option C is incorrect because that describes health or medical insurance. Option D is incorrect because it describes disability income insurance. Question 27. In which situation would a flood insurance policy be necessary? A. A pipe bursts and causes water damage in the home. B. The property is located in a flood-prone area. C. The property is affected by a nearby lake overflow. D. A hurricane causes a storm surge to flood the home. Answer: B. The property is located in a flood-prone area. Explanation: flood insurance is necessary for properties located in flood-prone areas or designated flood zones. Flood insurance is typically not included in standard homeowners insurance policies and must be purchased separately, while storms, surges, and other flood events may be covered under flood insurance. The need for such coverage is primarily based on the location of the property in a flood zone. Option A describes water damage from a plumbing issue, which is typically covered under homeowners insurance but not flood insurance. Option C may be a form of flood insurance depending on the specific incident, but location is the primary factor. Option D refers to a storm surge, which may be covered by flood insurance, but only if the policy covers it. Question 20. Which of the following is typically covered by a health insurance policy? A. Preventive care, services such as vaccinations. B. Accidental damage to personal property. C. Loss of income due to injury. D. Legal fees associated with a medical malpractice lawsuit. Answer A. Preventive care, services such as vaccinations. Explanation: health insurance policies typically cover preventive care, including vaccinations, screenings, and other services designed to prevent illness. Option B is incorrect because health insurance does not cover damage to personal property. Option C is incorrect because health insurance does not cover loss of income, which is typically covered by disability insurance. Option D is incorrect because legal fees for medical malpractice are not covered by health insurance but would be covered by malpractice insurance. Question 29. What does aggregate limit refer to in liability insurance? A. The maximum amount the insurer will pay for a single claim. B. The maximum amount the insurer will pay during the policy period, regardless of the number of claims. C. The maximum amount the insured must pay out of pocket for claims. D. The maximum coverage for damages related to a specific type of loss. Answer B. The maximum amount the insurer will pay during the policy period, regardless of the number of claims. Explanation. The aggregate limit refers to the total maximum amount an insurer will pay for all claims combined during the policy period. This limit is separate from the per claim limit. Option is incorrect because that describes a per occurrence limit. Option C is incorrect because the insured's out-of-pocket costs are determined by deductibles and coinsurance, not the aggregate limit. Option D is incorrect because the aggregate limit applies to all types of losses covered during the policy period. Question 30. What is the main purpose of umbrella insurance? A. To provide additional coverage for damages not covered by other policies. B. To cover damages caused by natural disasters. C. To reduce premiums on auto and homeowners insurance. D. To provide health insurance coverage for injuries sustained outside of the home. Answer A. To provide additional coverage for damages not covered by other policies. Explanation. Umbrella insurance provides extra liability coverage above the limits of standard policies like auto or homeowners insurance. It covers a wider range of risks, such as legal fees, and offers broader protection against catastrophic events. Option B is incorrect because umbrella insurance is a liability policy, not a disaster-specific policy. Option C is incorrect because umbrella insurance does not reduce premiums but provides extra coverage. Option D is incorrect because umbrella insurance does not provide health coverage.